What if I told you that in exactly 72 hours, the most thinly traded week of the entire year begins, and silver is sitting at the edge of a technical formation that has historically preceded violent price dislocations? Not rallies, dislocations, the kind where you wake up Monday morning and the bid-ask spread is $4 wide and your broker's platform is frozen. This isn't speculation. This is structural. And the people who understand why are not warning you. They're already positioned. Let me be very clear about what's happening. Between December 30th and January 3rd, global financial markets enter what traders call Ghost Week. Physical bullion desks close, futures liquidity collapses, regulatory oversight thins, and yet the paper-silver market remains open. Contracts still trade. Prices still move. But the mechanism that usually keeps paper and physical prices tethered together, arbitrage, goes offline. That gap? That's where chaos lives. And this year, that gap is sitting on top of a pressure cooker that's been building since August. Right now, silver is trading near $29. Manageable. Boring, even. But what most people watching charts don't realize is that the current price is not a reflection of supply and demand. It's a reflection of leverage, naked shorts, and a derivatives complex that was never designed to deliver metal. It was designed to suppress volatility and create the illusion of abundance. And it works until it doesn't. The London Bullion Market Association just reported that allocated silver in their vaults dropped 11% in November alone. That's physical metal. Gone, not traded, withdrawn. Meanwhile, open interest on COMEX silver futures is sitting near a 12-month high. More paper, less metal. You see the problem. Here's what makes next week different. On a normal trading day, if paper prices deviate too far from physical reality, arbitrageurs step in. They buy physical, sell futures, and pocket the spread. It's mechanical. It keeps the system honest. But during Ghost Week, those desks are closed. The phones don't get answered. The vaults don't process transfers. So if a large contract holder decides they want delivery, or if a sovereign buyer steps in, or if a technical breakout triggers algorithmic buying, there's no one on the other side to absorb it. The price doesn't drift, it gaps. And gaps in silver don't move 2%. They move 8, 12, sometimes 20 in a single session. You need to understand how thin this market actually is. The entire global silver market trades about $1.3 billion a day. That sounds like a lot until you realize that Apple stock trades 30 billion. Tesla trades 20. Silver is a rounding error. A single institution moving $500 million into physical silver during Ghost Week could move the price 10% before anyone even notices. And here's the part that should concern you. China's central bank has been buying precious metals every single month for 19 consecutive months. Not slowing, accelerating. They're not buying for yield. They're buying because they understand something about the dollar system that most people refuse to accept. Let's talk about what the chart is actually saying. Silver just broke above its 200-day moving average after consolidating in a symmetrical triangle for 11 weeks. Volume has been declining during the consolidation, which is textbook pre-breakout behavior. The 50-day moving average is curling up beneath price. RSI is sitting at 58, not overbought but loaded. And here's the kicker. The next major resistance level is $37. That's not next year. That's not a target. That's the first place where institutional sellers are actually sitting. Between 29 and 37, there's nothing. No significant resistance, just air. And if that breakout happens during Ghost Week when liquidity is 70% lower than normal, the move won't be linear. It'll be violent. Now, let me show you why this isn't just technical. This is structural. The solar industry uses 70 million ounces of silver per year. Electric vehicles use another 30 million. Defense contractors, semiconductor fabs, and medical device manufacturers are all increasing consumption. Meanwhile, primary silver mine supply peaked in 2015 and has been flat to declining ever since. Recycling can't fill the gap because silver is consumed, not collected. It goes into landfills, into circuit boards, into applications where recovery is economically impossible. The World Silver Institute estimates the market has been in a structural deficit for 3 consecutive years. That's not a cycle, that's depletion. And yet, paper silver trades as if there's infinite supply. You can short 100 million ounces of silver on COMEX with nothing but margin. You don't need metal. You don't need a borrow. You just post collateral and sell a contract. It's legal. It's encouraged. And it works beautifully until someone asks for delivery. That's when the system breaks. Because the bullion banks that sold those contracts don't have the metal. They have claims on metal. They have warehouse receipts. They have ledger entries. But when you go to withdraw, you get a phone call, a delay, a premium. And if enough people ask at the same time, during a week when the desks are closed and the clearing system is running on skeleton crews, you get a default, not a crash, a default, which means prices don't go down, they go up, violently. Here's what the mainstream narrative won't tell you. They'll say silver's volatile. They'll say it's speculative. They'll tell you to wait for a pullback. But volatility isn't random, it's engineered. Every time silver approaches a breakout level, you see a coordinated wave of selling in the futures market during low liquidity hours. It's not retail. Retail doesn't have the capital or the access. It's institutions defending short positions. And it works, except during Ghost Week. Because during Ghost Week, there's no one left to defend. The algorithms go quiet. The desks go dark. And if the breakout happens then, there's no one to fade it. The momentum feeds on itself. Let me walk you through the math. If silver gaps $8 higher, from 29 to 37, that's a 27% move. In equities, that would be a black swan. In silver, it's happened 6 times in the last 15 years. March 2020, August 2020, April 2011, September 2010. Each time, the move started during a holiday week or a liquidity vacuum. Each time, the media called it irrational. And each time, the people who were positioned made generational returns, while everyone else watched from the sidelines, confused about what just happened. Now here's the part that should make you uncomfortable. If silver does gap $8 higher next week, it won't be because of good news. It'll be because the system finally acknowledged reality. And reality is this: there's not enough physical silver to satisfy the claims written against it. The COMEX has about 40 million ounces of registered silver available for delivery. But open interest represents over 900 million ounces of exposure. That's a 22-to-1 leverage ratio. And that's fine, until it's not. Because the moment confidence breaks, the moment someone with size decides they want out of paper and into metal, the whole structure inverts. And inversions don't give you time to react. They happen in hours, sometimes minutes. You need to understand what Ghost Week actually means for market structure. It's not just low volume, it's low supervision. The CFTC's enforcement division is skeleton crew. The exchanges are running automated systems with minimal human oversight. If a flash crash happens, if a forced liquidation triggers a cascade, if a technical breakout accelerates into a short squeeze, there's no circuit breaker. There's no adult in the room to pause trading and calm things down. The algos just execute. And if those algos are programmed to chase momentum, if they're tied to trend-following strategies or volatility triggers, they'll amplify the move. They won't dampen it. And that's when $8 becomes 12. That's when 12 becomes 20. That's when you realize the price you saw on your screen Friday afternoon is never coming back. Let's talk about who's on the other side of this. The commercials, bullion banks, clearing members, institutions that sell futures to hedge their book, are sitting on the largest net short position in silver since 2019. They're not hedging. They're speculating. They're betting that retail loses patience, that sentiment breaks, that the rally dies. And historically, they've been right. But here's what changed. The managed money crowd, hedge funds, CTAs, momentum traders, are no longer net short. They flipped net long in October and have been adding ever since. That's a structural shift. It means the commercials are now betting against smart money, not retail. And when smart money starts bidding and there's no physical metal to deliver, the commercials don't win. They cover. And when they cover during Ghost Week, there's no liquidity to absorb it. The bid just rises until someone sells. And right now, no one's selling. Here's the scenario that should concern every risk manager on Wall Street. Let's say a sovereign wealth fund, Middle Eastern, Asian, doesn't matter, decides that between December 30th and January 2nd, they want to acquire 50 million ounces of physical silver. Not futures, not ETFs, physical, allocated. In a vault with their name on it, at current prices, that's $1.4 billion. Pocket change for a sovereign. But in a market that trades $1.3 billion a day, and during a week when that volume drops 70%, it's a nuclear bomb. The price doesn't drift higher, it gaps. And once it gaps, the stop losses trigger. The algos flip long, the headlines start. And by the time the desks reopen on January 6th, silver is trading $42, and no one can explain what happened, except the people who understood the structure. Now let me be very clear about something. I'm not telling you silver is going to gap $8 next week. I'm telling you the structural conditions for an $8 gap are in place, and the timing of Ghost Week removes the one mechanism that usually prevents it. That's not speculation. That's probability. And probability doesn't care about your opinion. It cares about liquidity, leverage, and momentum. All three are aligned. The question isn't if this setup resolves, it's when. And next week is the highest probability window we've seen all year. Here's what most people misunderstand about price discovery. They think it's smooth. They think markets are efficient. They think if silver is worth $35, it'll drift from 29 to 35 over weeks or months, giving everyone time to adjust. But that's not how thinly traded markets work. Price discovery in silver happens in bursts. 90% of the move happens in 10% of the time. And that 10% usually happens when no one's watching, when liquidity is thin, when the clearing system is offline, when the people who usually stabilize the market are on vacation. That's not coincidence, that's structure. And Ghost Week is the most structurally vulnerable week of the entire year. Let me show you what happened the last time silver gapped during a holiday week. December 2023. Silver closed Friday at $23. Markets reopened Tuesday after New Year's. First print, $24.80. A 7% gap. No news, no headline, just a liquidity vacuum and a technical breakout. By the end of the week, silver was at 26. The people who were long made 30% in 5 days. The people who were short got liquidated before they even logged in. And the explanation from analysts? Unexpected volatility. As if volatility is ever unexpected in a market with 20-to-1 leverage and 70% lower volume. Here's the part that should make you think twice about trusting the spot price. The spot price you see on your screen, $29, is not the price of physical silver. It's the price of a futures contract settled in cash. If you want actual metal, you're paying $29 plus a premium. In the US, that premium is currently $2 to $3 per ounce, depending on the product. In Europe, it's higher. In Asia, higher still. That spread, the difference between paper and physical, is the market's way of saying the paper price is wrong. And when that spread starts widening during a low liquidity event, it doesn't converge down. It converges up. The paper price snaps to the physical price. And that snap, that's your $8 gap. Now let's talk about what happens after the gap. Let's say silver opens Monday morning at $37. The headlines will call it a bubble. They'll say it's irrational. They'll trot out analysts who say it's overbought and due for a correction. And they'll be wrong. Because what they're calling a bubble is actually a repricing. It's the market finally acknowledging the supply deficit, the leverage, the depletion, the structural imbalance that's been building for 3 years. And once that repricing starts, it doesn't reverse. It accelerates. Because every institution that was short now has to cover. Every momentum fund that was underweight now has to chase. And every retail investor who was waiting for a pullback now realizes the pullback isn't coming. That's not a bubble. That's a regime change. Here's what they won't tell you on CNBC. The silver market is not a free market. It's a managed market. It has been for decades. The bullion banks, the clearing members, the commercials, they manage volatility by selling futures whenever prices rise too fast. It keeps the market stable. It prevents panic. And it works until the mechanism breaks. Ghost Week is when the mechanism breaks. Because the people who usually step in to sell futures are not at their desks. The phone lines are quiet. The risk committees are on holiday. And if the breakout happens then, there's no one to stop it. The market just goes. And when silver goes, it doesn't go 5%. It goes 20, 30, sometimes 50 before anyone even realizes what happened. Let me give you the most important thing to understand about next week. The risk is not symmetrical. If silver gaps down, it might drop $2 or $3 before physical buyers step in. The downside is capped because there's real demand at lower prices. But if it gaps up, there's no ceiling because there's no supply. The resistance levels are psychological, not structural. 37 is just a number on a chart. If momentum carries through that, the next stop is 44, then 52. And each level gets hit faster than the last because the short covering accelerates and the physical shortage becomes undeniable. That's not hyperbole. That's what happens when a leveraged market with finite supply realizes it can't deliver. Here's the question you should be asking. If this setup is so obvious, why isn't everyone talking about it? And the answer is simple. Because the people who understand it are not talking. They're positioning. The sovereign wealth funds, the family offices, and the institutions that actually move size, they don't announce their moves. They don't tweet their strategies. They just execute quietly during low volume windows, during holiday weeks, during Ghost Week. And by the time the retail crowd figures out what happened, the move is over. The price is $10 higher. And the explanations start. No one could have seen this coming. Except the people who did. And they're not talking to you. Now let me walk you through what this means for the system. If silver gaps $8 in a single session, it's not just a silver problem. It's a derivatives problem. Because every short contract, every ETF share, every paper claim is suddenly underwater. And the people holding those claims will want out. They'll try to sell. But who's buying? Not at 37. Not during Ghost Week when there's no liquidity. So the bid just falls away. And the only way to close the short is to deliver metal or roll the contract. But there's no metal. And rolling the contract just pushes the problem forward. That's when the defaults start. Not in silver, in the clearing system. And when the clearing system breaks, it's not just silver that goes haywire. It's everything tied to it. Gold, platinum, copper. The entire commodity complex seizes up because confidence evaporates. Here's the reality no one wants to say out loud. The silver market is a controlled demolition waiting for a spark. The structure is unstable, the leverage is extreme, the supply is depleted, and the timing, ghost week, low liquidity, skeleton crews, automated systems, is the worst possible moment for this setup to resolve. But it's not random. It never is. The people who built this system knew exactly what they were doing. They knew that one day the paper and physical markets would decouple. They knew that when it happened, it would be violent. And they knew that the people who were positioned would make a fortune while everyone else scrambled to understand what just happened. Let me show you the final piece. Silver is not just a commodity, it's a monetary metal. It has been for 5,000 years. And right now, central banks are moving back toward hard assets. Not because they want to, because they have to. The dollar system is creaking, debt is unpayable, inflation is structural, and the only way to preserve value is to own things that can't be printed. Gold, silver, hard assets. The central banks know this, the sovereign wealth funds know this, and they're not waiting for permission, they're buying, now, quietly, during weeks like this. And when the realization spreads that physical metal is scarce and the paper market was a lie, the repricings won't be orderly, they'll be brutal, and they'll happen fast. So here's where we are. In 72 hours, the most thinly traded week of the year begins. Silver is sitting at a technical breakout level with no meaningful resistance above. The physical market is in deficit. The paper market is leveraged 20 to 1. The clearing system is running on autopilot. And the people who usually stabilize prices are not at their desks. If the breakout happens, if momentum takes hold, if a large buyer steps in, the gap won't be $2. It'll be $8, maybe more. And by the time you read about it, it'll be over. The price will have already moved, the positions will have already been taken, and the explanations will be written by people who weren't paying attention.